Welcome back to Trading Club Q7U, the premium resource for learning trading from ground zero. I'm your lead educator today, and we're in lesson number 33 of our chart patterns with real movement module. I want to start today by acknowledging that chart patterns can seem overwhelming at first glance. You might see numerous shapes, lines, and symbols, and wonder how anyone can decipher them with confidence. That's why I'm here to break down one of the most significant patterns you'll encounter as a trader, the cup and handle pattern. The cup and handle pattern, also known as the inverted cup and handle, is a reversal chart pattern that helps us identify when a downtrend is losing momentum and a new uptrend might be starting. To understand this, let's think about a cup as a depression or a valley in a chart, representing the low point of a market, and the handle as the arm or the shoulder that extends from that valley. Imagine a cup as a well, and when a cup breaks, water starts flowing upwards. Similarly, when a market reaches its lowest point and begins to rise, it's like the water flowing upwards from the broken cup. The handle represents the point at which this rise may slow down or even temporarily pause, before potentially resuming upwards, forming a new trend. In trading terms, the cup and handle pattern typically forms at the end of a downtrend, where the price dips and then rises, forming a cup. This is followed by a smaller, more shallow dip, which we call the handle. The handle typically breaks below the lowest point of the cup, indicating a possible continuation of the upward trend. To see this in action, let's use a simple example. Say a stock was trending downwards, reaching a low of 10 before bouncing back up to 15. After this initial bounce, the price dipped again to 12 and then rose back to 17. If this happens, the price has probably formed a cup and handle pattern, indicating a possible return to the upwards trend. Now, let's break down the key elements of the cup and handle pattern. The cup itself is typically a well-defined U-shaped or rounded bottom reversal, in which the price oscillates between support and resistance levels. The price must break through the lower support of the cup to form the handle, which can be a simple downtrend, a wedge, or even a small bearish pattern that's easily recognizable. It's essential to understand that the height of the cup and the handle is what differentiates a strong trend from a weaker one. A deeper and wider cup typically indicates a stronger trend reversal, while a shallower cup may indicate a weaker reversal. The handle, on the other hand, should be much smaller than the cup to confirm the reversal. Let's also discuss the timing of the cup and handle pattern. This pattern typically appears at the end of a downtrend, but not always. It's crucial to note that price movements are influenced by external factors, such as news, economic releases, and sentiment shifts. So, the timing of the pattern should be taken into account, along with any external factors that might affect the market's movement. Now, let's talk about common mistakes beginners make with this pattern. The first mistake is expecting the pattern to work every time, and ignoring the fact that trading is a probabilistic game, not a guaranteed one. Another mistake is rushing into trades when the market doesn't match the textbook pattern perfectly. Another mistake that beginners often make is not considering the significance of volume during the cup and handle formation. Low volume during this formation can be an indication that the market is experiencing a lack of buying or selling pressure, which may affect the price trend's strength. To avoid these mistakes, it's essential to remember that chart patterns like the cup and handle exist on probability grounds, not certainty. We have to trade according to the market's movement, not the pattern itself. So, what can you do? Practice patience, and remember to analyze the market's real movement, rather than just expecting a pattern to work. For our practical exercise today, take any stock on a demo chart, and try to identify past instances of the cup and handle pattern. See how the price has moved in real time, and what happened after the pattern formed. Take note of the handle's shape and size relative to the cup, and remember that it's not set in stone. Markets can be unpredictable, so always keep a critical eye on the trade. When analyzing the pattern on your demo chart, consider the following. Look for other external factors like news, economic releases, or shifts in sentiment that may have influenced the market's movement. Take your time and think carefully about the market's movement before making